recorded anyway, so if anyone wants to tune in later on, they'll have time to do so. All right, let's start. First of all, guys, thanks for being here with me today. This is class number 4, and I'll be diving into the infamous market maker model. So this series will be in several parts. So today's class will be part number 1, market maker model. Before getting into market maker model, I actually want to talk about a little bit of interbank price delivery algorithm and its price delivery cycles because without having an understanding of how price moves, market maker models, it doesn't actually make sense. So let's take a look at interbank price delivery algorithm price delivery algorithm. So this figure actually stands for how price delivers on a daily basis, um, which is basically which basically tells us how price starts moving, where it goes, what it shouldn't do, what it should do, and stuff like that. So as a starter, what happens in the marketplace is market always starts with a consolidation. Okay, this is the first leg of any kind of move. Any expansions you see in the marketplace, distribution, accumulation, whatever the case is, it always starts with a consolidation. Okay, and it always goes from consolidation to expansion. Now, expansion doesn't necessarily mean price moving higher. It also means price going lower. It's the same thing. Either expands higher or expands lower. After the expansion, two things can happen. Okay, you guys? First thing, it either consolidates, expands, and then retraces, and then expands in the same direction. This is a continuation price delivery. Or the second way would be consolidation, right? Expansion, and then reversal, and expands in the opposite direction, and then consolidates again. Which is this price delivery interbank price delivery algorithm is actually the market maker model itself. The reason we like to use, or I like to use market maker model is because it technically simplifies how the price delivery happens. It helps us to understand whether we are in consolidation or in the reversal phase, expansion phase, are we tracing and all that stuff. Sometimes we get lost, but with market maker model, the aim is to have that bigger picture in mind going through in the marketplace. Now, before skipping this slide, I also want to mention one more thing. So this is what you should or you can't see in the marketplace. The consolidation is the first stage, right? So after consolidation, there's never going to be a retracement. A price move never starts with the retracement. Same thing with reversals. Consolidation never leads a reversal. And also, another thing, after an expansion, there's never going to be a consolidation. It either goes like expansion, retracement, and then consolidation. It's never going to be like consolidation, expansion, then consolidation. Okay. Now this is the visuals of the same thing I was just talking about. This is how it looks like on the charts. When you look at the chart patterns or like bars and stuff, this is how it looks like. It's the move always starts with a consolidation, the first leg, and then expands, in this case higher, retraces, probably like an equilibrium of the range or discount array, and then expands again. And the second way of interbank price delivery is consolidation is this first stage, then expansion and reversal. Now after reversal, what's going to happen is it's going to keep going lower, which is the continuation in the opposite direction or expansion in the opposite direction. You'll never see consolidation, expansion, then consolidation, where consolidation, reversal. That's not going to happen. Now let's jump into market maker model, having the intermarket price delivery in mind. What is a market maker model? A market maker model is the blueprint of how intermarket interbank price delivery algorithm delivers the price. Right now, we know everything is algorithmic delivery because how precise the market is actually is. It is not buying or selling pressure. At least I don't believe that. I believe it is the interbank price delivery algorithm. The idea of the market maker model is to build around liquidity. It is built around liquidity or power three, in which smart money or institutions manipulate price in their favor. And as a trader, our mission or our objective is to be able to see those manipulations and be in a position with the smart money within the same direction. Now, there are two types of market maker models, okay? And market maker, MMXM stands for market maker models in general. The first type is market maker sell model, MMSM for short. And the second type is market maker buy model, MMBM for short. The market maker model cycles includes three phases: accumulation, manipulation, and distribution. This is mainly because everything is built around liquidity in the marketplace. Market maker models delivers in three stages. Now, stages are different than cycles, okay? I want you to keep that in mind. These stages are low risk buy or sell, depends on whether it's a sell model or a buy model. First stage, accumulation or distribution. Second stage, reaccumulation and redistribution. Meaning the first stage expansion and then second stage expansion. And low risk buy, I'll get there. To have an understanding of market maker model and its stages, you must have an understanding of every ICT PD array. Now that's why I covered the PD arrays in the first class, because if you don't know what an order block is, or propulsion block, or rejection block, break block, fair value gap, whatever the case is, you will get lost in the market maker model concept. You will not be able to understand whether the market is in the first stage or the second stage or consolidation, whatever the case is. So if you're having a problem with PD arrays, I want you to, or you need to understand them completely before getting more advanced in the market maker concept. Phase one, original consolidation. Remember, every move starts with a consolidation. Now, what is an original consolidation? So in the concept of market maker models, accumulation occurs in the consolidated market, right? It goes sideways, which is also called original consolidation. And retail traders consider this phase as a choppy price action or sideways price action. Some call it barcoding, but we see as a consolidation, or we see that price action as smart money accumulating a position, whether it's a buy position or sell position. Consolidating markets always allow smart money to accumulate their positions without any significant price move within a very small range. So in the consolidation phase, market is not going to move or have big swing legs. It's going to consolidate within a small range, which can get frustrating for traders unless they know what a consolidation is, or unless they have a way to anticipate a consolidating market. And this phase is usually where the accounts get blown up. So be careful with that. You need to have a model or have a way to be able to understand the consolidations and anticipate that the market is in a consolidation phase. Accumulation phase or consolidation phase is the most dangerous phase to have a position in because of the reasons I just mentioned. And this is mainly due to price will seek both sides of the liquidity in a very, very short range, which is frustrating for us, especially for day trading. Now, this price action makes traders think market is moving, but in reality, it is in a range-bound accumulation. I'm sure you've all experienced the same thing. You thought market is moving, you open the position and you got stopped, and then you get frustrated, you enter it again and again and again, and you end up blowing your account for the day. And price did not move for the entire day. I'm sure everybody in here have experienced the same thing. which is why market maker models are important because it allows you to understand how long you should wait before putting a position in the marketplace. Now, for us, as smart money traders, in the context of market maker models, we can anticipate when the accumulation phase is over or is about to be over. This is where the model comes very, very handy. Now, to be able to anticipate the end of the accumulation phase or original consolidation, we need to use intermarket analysis. For example, or to be specific, our job is to look for divergences between assets. Now, I'm going to explain what I mean by this later on in this presentation, so don't get confused about what a divergence is. So the smart money tool, which is a divergence or SMT divergence for short, is the very first sign that an accumulation phase or consolidation phase is over or is about to be over. Okay. Let's take a look at the market maker profiles. This is a typical market maker buy model profile. Now what happens is what we see here is basically the first move here on the left hand side, market accumulates positions here. So smart money is accumulating short positions in this price action, which we consider or call as original consolidation. Then it distributes lower in a couple stages, and at the low of this expansion leg, we're going to have some kind of reversal. Okay, that'll be the second phase of the market maker model. But now I want you guys to focus on the original consolidation, the first phase, because we need to understand the first phase first. And after that reversal forms at the lows in the buy profile, market starts distributing and starts targeting the original consolidation. And the reason being is basically smart money is distributing their profits. So they're either mitigating their profits, closing their positions, covering their positions, right? And or reversing their positions, now going long and targeting the buy side to get out of their positions in a fair price action, which is why in market maker profiles, in the buy profile or the sell profile, same thing. The original consolidations, the first consolidations are always the high probability targets, the phase one stage. And the sell profile, everything is flipped now. Same thing, price starts with an accumulation and consolidation, right? Then it distributes higher. In this price action mark, what happens is smart money accumulates long positions within a short range, and then the market rallies, right? And at some point, like a point of interest, liquidity, daily high, or whatever the case is, at some level, they start reversing. So this is the reversal price action, which is phase two. I'll get there for the market maker model. And in that reversal, what's going to happen is the smart money or institutions are going to be covering their long positions or start selling short at the highs, which is a fair price for them to go short for. And where are they gonna try to exit their short positions now? They're going to be targeting the old lows, the accumulation lows, to get out of their short positions now, because that is where the sell stops lie, right? Remember the liquidity class. And this is how a sell model, market maker sell model, or a buy model profile usually looks like. Now this happens in a couple of stages, like I mentioned earlier. But in this class, I'm just going to be focusing on the phases here for the original consolidation and the reversal. And stages, I'm going to be leaving that for other classes just because I need to go over them in detail. But it's a general rule of thumb. What happens is the first stage is the accumulation, original consolidation, reversal, the first stage, and then it starts. This is the first stage, distribution. Second stage redistribution, and this is the end of the sell model. So it completes the interbank price delivery algorithm, completes the model there once original consolidation is getting rated. Now you might be asking like, okay, fine, consolidation, but we see a lot of consolidations in the price action. How do we know it is original consolidation? How do we know we should be targeting those highs or those lows? Now let's take a look or deeper look in original consolidations to be able to understand what it really is and how it really looks like in the market, in a real chart, in real price action. Now what I want you to do is I want you to imagine the US and Canada border, right, the country. Now draw an imaginary border here. Draw an imaginary border on the price action to separate the two portions, right? Now I want you to think as the upper portion as Canada and the lower portion as United States, right? And the imaginary line is the country cross, the border between the countries, right? Now what's important here is when you draw that imaginary line, you need to be able to see price respecting a certain level, okay? Sort in a way of like support and resistance, right? When it's coming from Canada, for example, it's going to be facing with some sort of support. When it's coming from United States to the border, now it's encountering some sort of resistance. So what you need to look at is a level where it rejects from both sides several times, right? This is what I call, or what we call, as smooth edges. Now, if you look at the price action that I circled here, price comes there several times, 5 or 6 times, respects that level with bodies, smooth edges, right? And rejects it several times. And on the other side, on the right hand side, the same thing from the downside from US now, it's testing from below and rejects that level, so it acts as a resistance and respects with the bodies, creating smooth edges. Okay, now you can consider this price action as your original consolidation. And how we're going to use this information is basically we're going to be choosing our targets by using original consolidation concept. But if you don't know how to find it or understand original consolidation in the marketplace, you might get lost. So pay attention here. Smooth edges, you want to see price respecting a certain level. So if it's not doing that in an accumulation phase, you cannot consider that range as your original consolidation. Okay. Now, the sign of an accumulation phase is when market goes back and forth, okay, several times in around a level. That's the country border, and test that level both multiple times from the upper portion and the lower portion and create smooth edges. Okay, smooth edges meaning like the bodies are respecting, right? The body is closing or opening at around the same level. That's what I call or we call as smooth edges. Don't get confused with the words there. Now this is how you establish an accumulation phase, original consolidation. And once it's established, now we as traders, now we know that we should not be a part of this kind of price action unless you want to get chopped, obviously. Okay, you got to be patient with this kind of price action. For an example here, I put a buy model, typical buy model. Now I want you to just disregard the smart money reversal area. I want you to focus on the original consolidation above the high. Okay. And what happens here is the market is range bound up there in a small level. Okay, now it's accumulating, so it allows smart money to accumulate positions here in this accumulation. Then it starts distributing, starts going lower. Okay, and once it starts going lower, at some sort of liquidity pool or a fair value gap, whatever the case is, it starts reversing. Okay, once it does that, now you can safely say, okay, now we have a buy model. Okay, now the original consolidation we've established will be targeted, so that'll be your buy side target in the buy model. Now the reason I love market maker model the most is because I remember back in the days when I started like studying ICT or started trading with ICT concepts in the first place, I used to get confused a lot with targets. Okay, now I understood the concept of fair value gap, entering in a fair value gap and stuff, but when it comes to targets, I was so confused because I was thinking about, oh my God, we have, so in this price action we have one high, second high, third high, fourth high, fifth high, like five buy side liquidity here. I was like, oh my God, which one I'm going to be targeting, right? And I got so confused. I used to, prematurely close my positions because of that. Now, what market maker models allows you to see the actual liquidity pool, the real liquidity pool, okay? Now, in this case, the real liquidity pool will be the original consolidation, okay? Now, can I zoom in here? No, I can't zoom in. Now think about the smooth edge or the imaginary line, the border here in the accumulation phase. Now what you see here, imagine you draw a line at around this level, okay? Now look at the bodies of this candle, then this one, this one, this one, this one, these ones over there. They are respecting one precise level. One level. Not two, not three, not four. Just one imaginary line, that level. Once you see that price action, that is your original consolidation. You can annotate that as original consolidation, and it will provide you the highest probability to target once the model is in the price action. Now, I'll be talking about smart money reversal later on. My main focus is not there right now, so if you have any questions about that area, just so you guys know, I'll cover that in a bit. Now, on the flip side, for the sell model, remember the sell model profile. The move starts with an original consolidation, right? It expands. Now, smart money is covering their positions. We're going short here at the highs at the fair market value, and then price starts reversing. Once the reversal's established, now you can say, okay, where's the original consolidation? Where's the accumulation? Now I can target that low in the sell model. Now look at the accumulation phase here. Look at this price action. How do we establish that? Now draw an imaginary line. Remember the country border, okay, here. Now look at this price action. These bodies, wicks, respecting one certain level from above, then from below the same level. 1, 2, 3, wicks. All those wicks and bodies are respecting the same level. So one level acting both as support and resistance. That is how you establish the original consolidation. Then you wait for the model itself to build to target those lows, okay? Which allows you to not overcomplicate the concept of sell side or buy side, the swing lows, swing highs, and stuff like that. Now, another beautiful thing about market maker model is, which is why I love it so much. Let me go back to the profiles again. When interbank price delivery algorithm delivers a price, okay, completes a profile, whether it's a buy model profile or a sell model profile, what happens is, or what we know is, once it completes the model, meaning trades above the original consolidation, price will consolidate, okay? Same thing on the sell side. Now flip everything. Once the algorithm completes the sell model, meaning trades below the original consolidation, that means the sell model is completed. Now it will, or likely, to start consolidating below that original level, original range. Now, knowing that information, what we can do by using market maker models is we can also anticipate consolidations so that we can stay away from the markets until it gives us some sort of sign that consolidation is over. Now, this is the thing I was talking about earlier. The price delivery, okay, starts with consolidation, expands, either retraces or reverses, okay. After retracement or reversal, you'll see another expansion in the same direction if it's a retracement. If it's a reversal, you'll see an expansion in the opposite direction, and then it'll start consolidating. Now in the market maker model concept, this is the same thing. Let me go back here. Consolidation, expansion, okay? Retracement, another expansion. Now it's consolidating again. Now it reversed, okay? Reversal, expansion, expansion. Now it's in the opposite direction. And when it completes the sell model, it starts consolidating. Now it is getting ready for another move, whether it wants to go lower or higher, okay? Remember, every time you see a consolidation, that is the first stage of any kind of move. There's the first stage of expansions. You'll never see consolidation followed by retracement. You'll never see consolidation followed by reversal, or expansion then consolidation. You'll never see that. Consolidation and consolidation. Now, this is a chart example of how to anticipate consolidations by using both market maker model and the price delivery algorithm. What you'll see here is there's a buy model. So horizontal consolidation. Why? Because there's smooth edges at that level. Prices respecting from above and below, respecting the bodies and just wicking there, so it acts as a support or resistance. So you can take the whole range as a horizontal consolidation. And that consolidation's high in the buy model will be the buy side and your target. It expands lower, creates some sort of reversal here, and then what happens is a reversal is a consolidation as well. The price consolidates, expands, retraces, expands one more time. This is the continuation delivery, price delivery. Now with the second expansion, what we see here is it completes the buy model, okay, because it's trading above the original consolidation. Once it does that, now you can say, or you can anticipate, a consolidation before anything else, okay? Remember the price delivery: consolidation, expansion, retracement, expansion, and then if it completed the buy model or the sell model, it comes back. The cycle starts from all over again. So it comes back down to consolidation. Now within this consolidation, what's going to happen is if it wants to go higher again, it's going to consolidate, then you're going to see another expansion. If it wants to reverse and target the sell side again, you're going to see an expansion or a reversal lower out of that range, okay? That is how we anticipate a consolidation. Now, knowing this information, what we do or like to do is our objective basically is, if you can anticipate a consolidation after a model is completed, you just stay away from it until it breaks out, whether to the downside or the upside, okay? Now the key takeaways about the phase one. Phase one is the horizontal consolidation. Okay, horizontal consolidation phase is essentially an accumulation phase, in which smart money accumulates their position in the direction of the market. Okay, whether it's the sell model or the buy model. Horizontal consolidation is the origin of any kind of move. Why? Because it is the consolidation. Market starts with consolidations, always. Horizontal consolidations are the highest probability targets in the context of market maker models. So instead of choosing individual highs or lows or equal highs or equal lows, whatever the case is, if you want to be trading the market maker models or MMXM, the highest probability targets will be the horizontal consolidation highs for buy models or the horizontal consolidation lows for the sell models, okay? To be able to understand the consolidations, we look at the smooth edges, okay? Remember the border example. So our objective is to identify the original consolidations and see it as a potential target. And our aim is not to participate in the consolidating price action. So you have to wait for the consolidation to be over. Otherwise, you'll get chopped. You're going to blow your account. Because of the algorithmic price delivery, when a market maker model completes its cycle, meaning it raised the original consolidation target, now you can anticipate a new consolidation above or below the target so that you can stay out of that price action, which is the most important thing about the market maker models. I'll explain this later in this presentation also. This is, in my opinion, the most important part of trading. People always ask me when not to trade. How do you know when not to trade? This is how, guys. This is how. If you know it's going to consolidate, why would you even try to place a trade on? The expansion will be there tomorrow once it breaks out. You know what I'm saying? So this is a highly important. So instead of being scared of consolidations or getting chopped, your job is to anticipate that or to be aware of which phase you're at, the market is at, okay? Instead of being scared of consolidations or getting chopped. Phase two, this is the fun part, smart money reversal. So as I mentioned earlier, in the buy model profile, price starts with the accumulation and distributes lower, and at some point, usually liquidity pool, okay, this could be any kind of liquidity or a major level, session liquidity, whatever the case is, whichever the time frame is, you'll see this in every time frame, okay? At the lows for the buy model, gonna have another consolidation when it completes the model, okay, sell model, and in that consolidation, what we call smart money reversal. Now you'll have a framework. Now you have a buy model. Why? Because you have an original consolidation here at the highs, and then you have the expansion leg, and at the low of that expansion leg, you have a reversal price action. Okay. Now that establishes the buy model from original consolidation high to smart money reversal low. Now, understanding the reversal, smart money reversal, is highly important when it comes to market maker models, because otherwise, if you don't know it's the reversal or it's the smart money reversal, you're not going to be able to trade the buy model or the sell model, whatever the case is, the market maker model in general. So what we look for in this price action is a divergence. Now I'm going to explain divergence, what it is, shortly, but that is usually the early sign of a consolidation. To be to It tells us basically that the consolidation is about to end. Okay, once the smart money completes the reversal, now it starts moving in the direction of the actual liquidity pool. It expands higher. Okay, and in the buy model, it'll target the horizontal consolidation high. Until then, the buy model is not completed, and interbank price delivery algorithm is not going to stop until it completes the market maker model. Now on the sell model, smart money reversals will be at the highs and original consolidations will be at the lows, okay? Now what we see here is the same thing, just on the flip side. Accumulation, right? Then you're going to have an expansion leg, and at the end of that expansion leg, which is usually an old high or old low, like the liquidity level, at that level, you're going to have is a reversal pattern, reversal signature, which is smart money is reversing the market to go short at the highs in the sell model. Okay, in that smart money reversal area, you'll have divergences, which tells you at what phase the market is at the moment. So once you establish the reversal and the original consolidation, now you have the model. From original consolidation all the way to the smart money reversal high, that is your framework. That is where you'll be dealing with the price in. So you'll be looking actively for shorts in that price leg to target the original consolidation lows. Okay, and an important thing again here, the delivery algorithm will not going to stop until the sell model is completed. Okay, but your job as a trader is to patiently wait for the model to form itself. Okay, until then, if you can't spot the model, you shouldn't be trading. Okay, because otherwise that becomes impulsive trading. Now, this forms on every time frame. If you're a swing trader, you can still trade the model on the daily time frame, 4 hourly time frame, whatever the case it is. For daily day trades, same thing, 1 minute, 5 minute, 15 minute, and every time frame you'll see the model, market maker model. Now, let's take a look at a couple examples here. I showed this example earlier for the original consolidation. Now let's dive into smart money reversal area. So in this expansion leg, after the algorithm raids some sort of liquidity pool, okay, it starts stalling. Okay, now it's in a consolidation again. Okay, now in that consolidation, what's going to happen is it is going to create some sort of divergence in between assets. Okay, this is what we call SMT divergence. SMT divergence is simply mean one asset is making a higher high, in this case, this asset, whatever asset it is, making a higher high here, and the other one is making a lower high at the same level. That is what we call an SMT divergence. Okay, this is the one signal, like the most important sign of smart money reversal. Now you're in a reversal market. Okay, what you could do, or what we do for while we're trading the market maker model is once that range, the accumulation range, breaks, like price breaks out of there, now the smart money reversal is confirmed. Okay, once it's confirmed, you need to look for potential targets to go short. For for market maker model traders, what you could do, or what you will do, is you look at original consolidations. You'll find an original consolidation which causes the entire expansion here. Okay, that's your original consolidation, and you'll target its low in the sell model. Okay, once the reversal is there, that's your job. By doing so, now you don't have to be concerned about what lows you should be targeting, or you don't have to be concerned about the directional bias, because you know the directional will be one-sided delivery to the sell side, the original consolidation. That is the market maker model. It is not going to rate the highs again. It's not going to rally and take out the smart money reversal highs. Okay. I want to mention one more thing about this. I forgot. Okay, let's take a look at the buy model now. Same deal. Price consolidates, expands lower at the lows of the buy model. Once it completes this expansion leg at the liquidity level, so it purchases liquidity, then it starts stalling at that level. Okay, once it starts stalling, meaning starts accumulating, now you can look for or wait for a reversal, smart money reversal signatures. Okay, and that signature is the SMT divergence, because it establishes the smart money reversal. Without an SMT divergence, there is no smart money reversal. It means two things. One, the market is either in accumulation, or I mean consolidation. It is still in consolidation, it's not going to move. Or two, the reversal is not there yet, so it could still go lower. Okay? But if you have that signature, if you have that SMT divergence at a level of interest, now you can anticipate price moving higher, reversing there, targeting the buy side. And what's your target? As market maker model traders, you'll be looking at or spotting, finding original consolidations, and that accumulations high will be your target. Why? Because that is the highest probability target. The delivery algorithm will not going to stop. It is not going to stop until it takes out that buy side. So again, market maker models allows us to quote unquote simplify the targets as well, because in this price action, if you were to be long here without the context of market maker model, we'll be looking at this high, buy side, second buy side, third buy side, fourth buy side. You'll get confused, and over time you'll get overwhelmed. And again, over time, you'll get frustrated. But instead, what you can do is using market maker models, finding a high probability target, which is original consolidation, and just trade that. And another point, it also allows you to accumulate your positions along with the smart money. Okay, this is where you could potentially scale in a position. But I'll get there. I'll get there later on the other parts. For original consolidation, again, you look at the smooth edges. This level, market tests several times from below and above, respects it, creates smooth edges, which forms or which we consider as an original consolidation. If you look at the other price, the expansion leg, you do not see any kind of consolidation or any kind of smooth edges in this price action. Okay, so if you're watching live and trying to spot horizontal consolidations, usually you're gonna have just one horizontal consolidation above the expansion leg, the most recent expansion leg. Okay. Now let's dive into the divergences. Smart money tool divergence, for short, SMT divergence. Now there are two types of SMT divergences. Simply put, one is bullish SMT and the second one is bearish SMT. This is highly important to understand the reversals and the consolidations in general. Okay, this tool is highly important and very, very simple. Now, to be able to spot an SMT divergence, you must be monitoring intermarket assets simultaneously. Now, what I mean by that is basically if you're trading Forex currencies, you need to look for a divergence between Euro USD and GBP, British Pound USD. Or if you're trading indices, you look for divergences between Nasdaq, S&P 500, Dow Jones. If you're trading cryptocurrencies, you look for divergences between Bitcoin and Ethereum, because this applies for all market. If you're trading commodities, it applies to commodities as well. And based on the data I've collected over the years in stock market, this also works quite well. But it's a bit tricky because if you're familiar with stock market, there are like similar stocks like AMD and Nvidia, similar companies, right? You can look for divergences in between those two stocks, for example. But when it comes to like, it's a bit trickier with stock market. Anyways, let's continue. SMT divergence indicates the order flow in the marketplace is about to change, meaning the consolidation or accumulation or reversal is about to end. That's what it indicates. That's why it's important. Okay. So in the concept of market maker model, SMT divergence forms both in horizontal consolidations and smart money reversals, because essentially they're both consolidations or accumulations. Okay. Now our objective as traders is to time the end of consolidations by using SMT divergences. Now think about it. This is very powerful. Like, if you've been trading for at least a year, you know what I mean by this. Like, how many times you get chopped in a consolidation? I'm sure, pretty sure 1,000 times. Now, if you're utilizing SMT divergences in a consolidation, okay, now you can time that consolidation's end. You can time your executions. You can wait for that specific thing to get into a position safely. Okay, that is how powerful this tool is. Now the visuals. This is how an SMT divergence looks like. On the upper portion, you'll see bullish SMT divergence. Let's say we're looking at Nasdaq on the left hand side and the S&P 500 on the right hand side. What's going to happen is at the smart money reversals or original consolidations, one asset will make a lower high, then a higher low. On the other end, the other one will make a higher low, then a lower low at the same level, at the same swing low. This is what we call bullish SMT divergence. Okay, one asset is raiding the sell side, and the other one is failed to do so. And on the bearish side, bearish SMT, Now this divergence happens at the highs, and one asset raids the buy side, creates a higher high, and the other one fails to do so, creates a lower high, which forms a bearish SMT divergence. A bullish SMT divergence forms when one asset raids the liquidity, sell side, whereas the other asset fails to reach the sell side. Thus, bullish divergence forms at the lows, at the sell side. Okay, bearish SMT divergence forms when one asset raids the liquidity, the buy side liquidity, whereas the other asset fails to reach the buy side. Thus, bearish divergences form at the highs, at the buy side. Okay. Now, like I mentioned earlier, SMT divergences applies to all markets, whether it be forex, futures, commodities, cryptocurrencies, some stocks as well. So if you're wondering if it works in forex or whatever, yes, it does. So this is an example for the divergences. On the left hand side, there's Nasdaq chart. On the right hand side, there's the S&P chart. What happens is price accumulates at the lows, then distributes or expands higher. At this level, it starts stalling, starts accumulating again. In this accumulation, it forms a higher high on Nasdaq. Okay, and on ES, again consolidates, then expands to a level, liquidity pool, and at that liquidity pool, it starts consolidating. And in that consolidation, it forms an SMT divergence, meaning it makes a lower high. Comparing to Nasdaq, it makes a lower high. This is where you establish the divergence, the SMT divergence. Now you can say, okay, this is the reversal. Reversal is happening. The consolidation is about to be over. Now I can safely and actively look for short entries. Okay, that's how we use this tool. Before that, if you try to short it with one market structure shift, you'll get stopped more likely. You'll get chopped, unless you have a big, large stop loss. So simply put, by using SMT divergence, you can time your executions. It teaches you how to be patient also. Now, before market forms, let's take a look at key takeaways here on the phase two. Before market forms a smart money reversal, the market is not in high probability conditions. Why? Because as long as or until you have the reversal in the market maker model concept, sky is the limit. If it's bullish, sky is the limit. Okay, it'll not gonna stop. It will keep going higher and higher and higher. However, like how much you, regardless of how much you want to short it, it'll go higher. Okay, that first things first. Once it's there, now you have a framework. You have a dealing range. You have all that. Now you can deal with the price within that range from original consolidation to smart money reversal. Smart money reversals almost always contain SMT divergence at its highs or lows. Okay. Sometimes I get a question about this actually. Let me just clarify that. Some folks were asking me like, but there's no SMT divergence in between, like let's say Nasdaq and ES. Why is it dumping or whatever? I'm like, have you checked Dow Jones? Maybe there is the SMT that you've been looking for. So you gotta be mindful of that. If you really want to go short, like we have an example on the daily chart right now in indices, like if you're really bearish, if you really want to see an SMT divergence in between assets, but it's not there, okay, check with YM, Dow Jones instead of ES or Nasdaq. It should be there if you're correct. If not, you just go with the flow. You can just go with the order flow. Okay? Don't try to pick a top or a bottom. You'll get slapped by the market. So SMT divergence is one of the most important elements of market maker models because time is everything. I tell this to everybody, okay? You don't have to be right at all times, okay? That's impossible. You can't have a 1%, 100% win rate, um, or you can't predict the market correctly all the time. But what matters is, or your aim is being wrong, but being less wrong, okay? Being less wrong meaning timely executions. That's where it comes handy, the SMT divergence. Um, it helps you to get the best entry and the highest probability PD array. Okay. Without SMT divergence, there's no smart money reversal, no framework, no market maker model, no high probability conditions. And think SMT divergence as an early sign of an end of a consolidation or a manipulation. SMT divergence forms in both original consolidation phase and smart money reversal phase because essentially they're both consolidating price actions. The divergence applies to all markets. Now, why do we use market maker model? These are my personal reasons. You have different reasons if you've been already using market maker models, but this is my personal reasons. Okay. First things first, market maker model provides the highest probability of targets and trades and targets. Okay, like you guys saw one time a couple of weeks ago when I executed this position lot in live stream. There was equal highs. I went long using market maker buy model. I got a question. So one person, I don't remember who, asked me like, why are you not targeting equal highs, but you were just like closing or targeting 5 points below it? I said, because that's the original consolidation. That is the highest probability target. I don't care about equal highs. That is not high probability. And guess what happened? So it took me out. I closed my position at my target. Then it never rated the equal highs. It left behind. So that's why I love market maker model the most. It gives the highest probability of targets. Now, if you ever find yourself being confused about which high, low to get to target, market maker model becomes very useful. I used to be one of those people who used to get confused about like, what is the buy side, what is the sell side, which high I should be targeting or low should be targeting, and market maker model helped me to overcome that overthinking because essentially your target is nothing but an original consolidation in the market maker model concept. Okay, so it helps us to simplify the price action, helps us to optimize the time of our executions, meaning you you are becoming less wrong. If you're wrong, you're becoming less wrong by optimizing the time of your executions. Market maker models provide the highest probability framework, meaning the dealing range is established for merger and consolidation to smart money. That is the range you'll be dealing with within the market, within the price. The model is a highly useful concept when it comes to position management as well, because interbank price delivery algorithm will not stop expanding in the direction of the draw until it completes the model. Okay, it is going to keep expansion. It's going to be something like this: consolidation, expansion, retracement, expansion, until it hits the original consolidation target. So another reason why I like to use market making model is because it gives me the confidence that I need as a trader. Okay, because I know for a fact that the price delivery algorithm will not gonna stop. So it helps me to calm my mind while I'm in a trade, so I don't get to be scared of the 15-minute fair value gap below my entry, for example, if that makes sense. So where was I? Okay, market making models helps us to understand different delivery stages of the interbank price delivery algorithm. And I'll cover the stages in part two and three, but the first stage is original consolidation. Okay, the consolidations, meaning original consolidation and the smart money reversal. That is the first stage. Before that, there is no market maker model. When we see the price action in the perspective of market maker model, we can be flat throughout the consolidations. That is the biggest upside for me personally. I hate getting chopped. I hate getting stopped in a consolidation, or I hate blowing my accounts within a short range, like today's range, for example. I hate it. I like. I'm sure you guys also hate that too. It allows me to sit through that kind of price action, which is a huge plus. Same thing. It helps us to anticipate consolidations. Okay. Now let's take a look at a couple examples here for the for only the first stage, the original consolidation and the smart money reversal. Now this is an example from Nasdaq and ES. 4 hourly chart. On the left hand side there's Nasdaq, on the right S&P 500 futures. So there's an original consolidation at the highs, okay, because smooth edge is right there. It respects that low, that level with bodies, just wicks through it, forms the original consolidation, and it distributes all the way down here at that level, that specific level. It creates an SMT divergence. So Nasdaq is making a higher low here, whereas ES making a lower low. Okay, that is the divergence that we've been looking for. Now, once you have that, the SMT divergence, you can do two things. You can anticipate the buy model. You look at the original consolidation right away as a target. Okay, enter right away. That will be the aggressive approach. You put your stop loss below the SMT because invalidation of that SMT divergence is the invalidation of the buy model in this case. Okay, or for a safe entry, you wait for a market structure shift like one high to get violated with body, and then you can actively look for an entry targeting the original consolidation high because it's the buy model. And the same thing on ES. Original consolidation, market chops around here, accumulates positions. The level I annotated was respect a couple times from down, up here, from the upside as well. So I annotated that as my original consolidation. And distributed lower. At the low, at this certain level, it created a bullish SMT divergence, made a lower low, whereas Nasdaq was not able to do so. So that was the first signature. Then you can wait for a structural shift to enter the position, and after entering the position, now you can safely you can say like, okay, now let the algorithm do its thing. Basically, you target the original consolidation high, and then you let it go. Now this one is from Forex example. On the left hand side, you'll see Euro 4 hourly chart. On the right hand side, it's a British Pound USD 4 hourly chart. The accumulation up here at the highs causes a distribution. At this level, price starts stalling, and Euro making a lower low, whereas British Pound GBP is making a higher low, creating an SMT divergence. Once you spot that divergence, now you can say, okay, this is the reversal. Smart money is reversing here. Now I should be looking for a potential target, the original consolidation, and it's high. Once you establish that framework, now you can work within that range and target that high. Same thing with GU. Again, the safest thing to do here is waiting for a confirmation, like one high getting violated would be your confirmation. Then you can actively seek for long entries, or you can also aggressively enter at the smart money reversal SMT divergence area to enter, which is called low risk buy, low risk sell. I'll cover that later on in the other parts of this series. I'm not diving into executions just yet, but there are a couple ways, different ways to trade the model. This one is from cryptocurrency example, the most recent price action actually. On the left hand side you'll see Bitcoin weekly chart, and on the right hand side there's Ethereum weekly chart. So the original consolidation price accumulates on Bitcoin, then distributes lower at the lows. It starts diverging, comparing to Ethereum, making a lower low, whereas Ethereum is making a higher low there, forming a bullish SMT divergence, which confirms the smart money reversal. Now, once the one buy or one order block is violated, that is your confirmation to go long and target those consolidation highs. What I personally like to do is, if I'm bullish biased, I wait for the smart money reversal, wait for that SMT divergence. Once the SMT divergence is there, then I zoom out a little bit and find the horizontal consolidation. Once I spot the horizontal consolidation, now I have a framework, right? The high from high to SMT low, smart money low, is my framework. So I'm trading within that range. Um, the smart money reversal should be anticipated only at a higher time frame PDR. No, that is incorrect. Smart money reversal can happen on any time frame. If you even go down into microsecond charts, like 5 seconds, you'll see the same price action. It happens on 1 minute, five, every time frame. Okay, I meant STAPDA. I don't STAPDA. You know what? Let me finish this, then I'll get back to your question. How about that? I'll get back to your question, Hans. Hans. Now the other concept is trap positions. This is also a reversal type, one of the reversal type. But in this type of reversal, smart money reversal, you're not going to be seeing SMT divergences. Usually, it's not going to be present in the marketplace. You got to be think quicker for this one. Now, what is a trap position? Trap position is essentially a very common type of price action in the marketplace that refers to late long buyers or late short seller positions that gets trapped. Okay, the interbank price delivery algorithm traps positions to generate liquidity to later run on liquidity in the direction of the drawn liquidity. Okay, now as a general rule of thumb, this type of price action is usually been seen in judo swings, smart money reversals, and sharp turns are the most common three forms of um, traps. Okay, so as a trader, we use this type of price action to understand that the market or the algorithm should not give an opportunity to trap traders to mitigate their losses at a fair price or break even. Okay, that's why the sharp turns usually happens. Now, if you look at the chart on the right hand side, what happens is this is how we usually understand whether the price action was intentionally to trap positions, to trap traders. Now it distributes lower, creates one CB here, okay, bearish fair value gap. Now below that bearish fair value gap, price spends time a little bit, meaning accumulates there, okay. Now after that accumulation, it expands higher in an energetic way, inverts the last bearish fair value gap. Once that inversion happens, now you can say, okay, the accumulation below the fair value gap was there to trap, in this case, shorts or trap positions, okay? Now, knowing that information, knowing that accumulation was there to just trap people or smart money, whatever the case is, now you can say, okay, the price delivery algorithm has no reason whatsoever to get back down there. Why? Because think about it for a second. In the practical things, in terms of practicality, like of things here. Say you saw this price action, okay? It expanded lower, and you don't know how to trade or whatever, and impulsively you entered short, okay, in this price action in accumulation. There are millions of people doing the same thing there, okay? What happens is, Once they get in short, price reverses, okay? And now they're in net loss. Their position is net loss and unrealized net loss, okay? What happens is algorithm will not gonna let them close their positions at a fair price, meaning in that range or below it, okay? So it's just gonna rally even higher. Frustrates them. It'll frustrate them, and it's just gonna rally higher. Now, knowing that information, how you can use this is basically this is a form of a Judas swing or a smart money reversal without an SMT divergence. Usually, sharp turns are the very common like signature of this trap positions. And as a general rule of thumb, the accumulation should be like you need to see at least like 3 or 4 candles accumulating within a short range right below a fair value gap or above a fair value gap in a bullish example, and I'll get there in a bullish example as well. So what happens is once the expansion is there, one inversion fair value gap confirms the trap positions, and after that algorithm should rally higher. So let's say you spot this price action, you saw this fair value gap, the anticipated drawn liquidity was already higher, you've already established that, you enter in that fair value gap. Now you know that the delivery algorithm should not trade into that range again, or it's low. It should rather keep pressing higher and higher and higher. Okay, in my opinion, it's a powerful way to read the price action as well, like in terms of manipulation. This is a manipulation essentially, Judas swings and stuff. This happens quite a lot. To understand if price delivery algorithm's intention is to trap people or traders or not, we'll look at small consolidations, okay, with energetic moves prior, meaning usually you'll have a fair value gap below or above it, depending on if it's a bullish case or a bearish case. Now let's take a look at the bearish case here. So what happens is price just expands higher, right? This is the trap expansion. Now this creates impulsiveness in people, okay? Especially in retail traders. I used to do the same thing. They start longing, and in this accumulation, price stays above a fair value gap, bullish fair value gap, spends time there for a little while, and then immediately after it distributes lower. So it breaks lower, inverts, and invalidates the bullish fair value gap. Once it invalidates that fair value gap, then and only then you can say, okay, this was trapped positions, in this case trapped shorts. The delivery algorithm has no reason whatsoever to rate its high again, because it doesn't want to give the trapped people to close their positions at a net profit or break even or a fair price. Okay, what it's going to do rather is it's going to keep expanding lower and lower in a faster manner. Okay, this is a typical Judas swing price action. It happens quite a lot, like I said, and it's also in the context of market maker model. This is also smart money reversal, and in this type of reversal, you don't necessarily have to have an SMT divergence. Okay, one inversion fair value gap is more than enough, but you must have an accumulation right above it, and preferably, this is also very typical, the bodies of that accumulation will respect the fair value gap below it. Okay, trading example. Okay, before getting into the exercises, I'm gonna take questions and I'm gonna answer your question, Hans. Okay, let me take a look at it again. The smart money reversal should be anticipated only at a higher time frame. PD array, right? Not necessarily. So that is a question that I was asked earlier as well. So because time is fractal, what happens is, so as a general rule of thumb, what happens is you need to combine several time frames. For example, 1 hour PD array forms 1 minute market maker model, or 4 hour PD array forms 5 minute or 15-minute market maker models. if that makes sense. That's that. Like for example, um, let me find an example right about there. So let's say this is not a good one. Let me find a good one here. So let's say this is the hourly chart, okay? Let's say this is the hourly price action. Here on the last leg, once price trades into an hourly PD array, in this case a BC, fair value gap, what you should do or what you should see is on the 1 minute or 5 minute, it's gonna form another market maker buy model. Okay, that's how you multi how that is how you do multi time frame analysis when it comes to market maker models. I think. Oh, you requested. I accept. Okay, here you go. You are muted, just so you know. Yes. I see what you're saying. I mean, that depends on the price action itself. I mean that actually depends on a lot of different elements. But as a general rule of thumb, I mean, it all depends on the price action. Like, let's say I'm gonna go on the chart for that. 1 second. What is this? What is going on? Hold on. So first of all, it doesn't have to be at a higher time frame PD array. Okay, it can happen on any kind of PD, any time frame PD array. However, however, the reason I said it depends is basically because this is, oh my God, it's so laggy. Oh my God. 1 second, bro. Okay. So what happens is, let's say you're looking at the Nasdaq daily chart, right? You have a POI, point of interest, at the, you know, daily fair value gap. You're expecting a bullish move or a continuation higher, okay? In this case, yes, you're gonna have a reversal at that level on a little different time frame though. Like for example, if I go on to like a 1 hour chart, for example, you'll probably see that here, okay? This is probably an SMT divergence there, and you'll have an hourly market maker buy model at a daily PD array, okay? Um, so my point is, it really depends on the price action because it doesn't necessarily have to be at a daily PDA. That's what I'm trying to say. Like you cannot generalize that like that. You see what I'm saying? I mean, in fact, let me check it out if that's an SMT divergence there or not. It probably is though. So what's time? January 31st. Here is this price action. So at the lows, there's no SMT there, I believe. But let's take a look at YM. January 31st. Okay, here. You see? There's what YM. I mean, I hope that that answers your question, but like I said, there is no answer, like no general answer to your question. But if you're like mainly trading intraday price action, what you can do is you can combine 15-minute or hourly PD arrays with lower time frame market maker models like 1 minute or 5 minute market maker models. You're still muted, by the way, if you're talking. Just so I know. Got it. Thanks. You're welcome, brother. That's a great question. Um, I'll give you my general rules for that. I have a general look for that. Um, I was thinking about covering that on the other parts though, because Matrix, another member of the group, asked me a very, very detailed question about that same thing as well. So I want to cover it in more in depth, hopefully in the other parts though. SD sharp turn. This is really powerful. Okay, guys, if you have any questions, I'll take it now, before giving you the exercise. You gotta always wait for the smart money reversal because you don't know where the actual reversal will take place in. So for me, I like to trade safe. Because of that, I wait for those signatures. So I wait. I have to have the original consolidation and smart money reversal, preferably with SMT divergence. If I don't have it, I don't touch it. And another thing is, sometimes what happens is you'll see the reversal happening, but when it comes to spotting original consolidation, you're not going to be able to see that because it's going to be a single, like for example, it's going to be a single low just like this one right there. In those cases, what I do and what you should do is just change the time frame. Go on the like for example, this is hourly chart, right? Go on the one lower time frame. Go on the 15-minute and try to look at the exact level, to see if there are smooth edges there on the 15-minute. If there is, just use the 15-minute market maker model instead of the hourly chart. So, as a general rule of thumb, when it comes to time frames, whichever is the easiest to see at the time of that price action, use that one, if that makes sense. You're welcome, brother. Does a higher time frame market maker model will always have a smaller time frame maker model, or it's not necessary? Yes, it will. Why? Because, like for example, here, what you see is a higher time frame. Let me just zoom in. A higher time frame market maker model, right? Now, and every pullback in this time frame will be a market maker buy model on the on the relatively lower time frame. So this is hourly, okay? Now, for example, when it was forming this order block here, if I go on the, let's say, 1 minute, hold, let me do a replay because otherwise I'll lose it. So hourly chart, pulling back into a fair value gap, right? Now let's take a look at the same price action on the 1 minute. Here, this leg, okay? Now I'm going to pull ES as well so we can see the divergences and stuff. Hourly chart, here somewhere there. Oh shit. Hold on. Friday 8th, March 8th. Here, okay. Alright. Now, if you look at this pullback, this is the pullback on the hourly chart, but we're looking on the perspective, with 1 minute time frame. Okay. Now, if you look at the lows there, here, Nasdaq is making a higher low, ES is making a lower low. Okay, that is your smart money reversal. Once it's there, now you look at the original consolidations. But one thing in mind, doing this is your smart money reversal. SMT is there. Okay, now you have a buy model. But in reality, you're actually trading a pullback on the higher time frame. So you got to keep that in mind because the order flow is actually bearish. In this case, it never comes all the way up to, the horizontal consolidations there. Rather, it's just wicking through the 1 hour PD array and then returns back. So what happens is, when it comes to your question, does a higher time frame market maker model will always have a smaller time frame market maker model? Yes, it will. It's not going to be as clean as this one right here, but there will be, because the lower time frame buy models in a higher time frame sell models are essentially the pullbacks on the sell model. It sounds a bit confusing in the first place, but I don't know how else I can put it down. Regarding smart money reversal, I realize that I often enter too early when spotting the SMT, but price will often turtle the soup 1 or 2 times before the real reversal. Any recommendations? So my recommendation is, so let me ask you this first, June. Do you tend to enter before there's divergence? Let me ask you that first. So you try to catch the turtle soup. Okay, I see what you're saying. So if you want to trade safer, even safer, what you could do is, okay, I'll delete all that, okay, so you can see it better. So there's SMT divergence. After that SMT divergence, there's a market structure shift right there, right? However, this is not the safest structural shift. Why? Because this up close candle is not your order block. It was never confirmed as an order block. So if you want to trade safer, you should be waiting for at least one order block being invalidated. In this case, there's this up close candles, two up close candles is your order block. So you should be waiting for that getting violated. Once it does that, so this fair value gap here could be your entry, and that'll be your safest entry. Now you'll never end up in the opposite direction of the market. But the thing is, there are also downsides doing this, because now you're entering at a much higher market price, and your risk might be bigger, or you might get a deeper pullback and stopped out in your position. So you better so you um your best bet doing this would be nailing position management, because on this leg higher, the order block is this low, these down close candles, or this one in fact, because that's lower. Okay, that is your order block, meaning your stop loss should be there. Otherwise, in one event of a deep pullback, you might get stopped out if you were to put your stop here somewhere. So safest thing to do is always waiting for the order blocks to get violated, because that is the real order flow change. Why is this purple? It doesn't even look good. Also, one more thing. Here's the thing about the smart money reversal. If you know that you're not trading pullback, obviously, so that this doesn't apply for a pullback price action. So if you spot the SMT divergence and you have the reversal, right? Let's say this is the target you wanna, this is the high you want to target, okay? What you could do is here. What you could do is you could enter aggressively at around these levels. That is the closest proximity to SMT divergence low, meaning this one. Because if you're wrong, here, let's say you entered there, your stop loss will be the lower low, and you let it go to your target. This is another thing you can do because if you're wrong, if market is not choppy, it is not going to violate the SMT. But in choppy price actions, what happens is sometimes it comes back down again. That's the problem. But one thing to mention here, like this in this kind of entry, this is an aggressive entry. It'll give you the least or the smallest stop losses. That's the upside. But it's definitely much riskier because you might get wicked out. This morning, for example, I think you're right. The real mistake is never put my stop loss on the high, low. Yeah, I mean, again, the same thing. If there's SMT, and if you're expecting, let's say in this case, buy model, that low that causes the SMT divergence should be safe. The price should not trade into there. If it does, it means you're either wrong or market is in a consolidation. It's not going to move. I'm looking at your chart. So, yeah, hold on. What time is this London price action on Nasdaq? Continuous charts. That's another thing. Look, you're trading London. Uh, I'm not so familiar with London price action, but I know for a fact that it tends to go for highs and lows several times before making a move. Let me find that price action. I think somewhere here. Consolidation. Okay, here. To me, I see this as a manipulation on the 15-minute candle close because it opened somewhere here. This is the open of 345, manipulates higher and closes this one right there. Actually, not even 15-minute. I would see this as an hourly candle manipulation. So it is setting up for the new hourly candle open, which is this candle. I mean this one. And look where it opens. It opens within that fair value gap. So for your answer, it is not because of SMT or anything. It's just time decay. This price action is just time decay. It is trying to set up the new hourly open. Like that precise level. 3-4 silver bullet, yeah. I mean, another thing you should be looking at is, like, let me pull up ES. This is a dangerous price action. Sweeps the low, never candle closes, and immediately rallies. What time? 3:40 Monday. Okay. All right. Okay, just like I thought. Here, where is the price action? Oh, it's not the same one. Okay, never mind. I was thinking about a potential bullish SMT short-term SMT divergence at the lows there. There's one probably. Okay, here's the thing. There's probably one on the 5-minute. Yeah, it's there on the 5, which causes that rally initially as well. Right there. So ES making a lower low. Nasdaq is making a higher low. So that rally on this time frame is a deep retracement, but on 1 minute, I would say that's the time decay, meaning it's setting up for the new hourly open, this price action. Something I'm starting to learn what you're teaching about opening of, yes. About that, okay, I was talking to Ravi, who is my um, coder. He writes like indicators and stuff. So he was talking about his indicators, liquidity rates, um, which essentially shows the hourly candle opens. Oh, it's not as clean. Like for example, the upper one I'm using for the afternoon session candles, 1 p.m., 2 p.m., 3 p.m., and the lower one shows the morning session hourly opens. You guys, it's a free indicator. You guys can, if you want to, obviously, you can add it to your um, trading view. It's easy to set up as well. You just go all the way down, open lines, and then put the times there. Here, 10 a.m., 11 a.m., 12 a.m. And it shows the open lines. And this indicator is called Liquidity Rates by Altmaniac. Just so you guys know if you want to. You're welcome, man. All right, any questions about the class, or I'm about to give you guys an exercise for the week? How does this liquidity indicator work? So, I mean, I'm not using it for its own purpose, but what I'm doing is I'm basically having the indicator to show me um, the hourly open levels here. So this is 1 p.m. hourly candle open, lines that up. This one is 2 p.m. hourly candle open and 3 p.m. hourly candle open. The way I use it is essentially I'm waiting for an AMD, like accumulation manipulation distribution around that level. So let's say, let me open the morning one. So this is how I personally use it. Today is not a good example, but I'm just going to cover it real quick. This is how I use it. Let's say I spotted an SMT divergence at the lows, like I spotted a buy model at the 10 a.m. candle open. I'm trying to enter a position below that open because that is the manipulation. So I'm trying to buy the manipulation. So later on, my stop loss will be safer, so I can also trail it aggressively. Because essentially what happens is once the hourly candle or 15-minute candle starts expanding, I can use its open price as my safe stop loss. So 10 a.m. opens, accumulates, manipulates lower, that's when I want to buy, then distributes and rallies higher. For you to set the indicator up, you go to settings, go all the way down. You don't have to deal with anything above here. You just go down to open lines, click on the open lines, okay? Then click on the other things down there, here, this one. You know what? I'm gonna screenshot this and put it in the group so you guys can have it. Then you put the time. So if you want the 11 candle, you put 11. If you want 12, 12. If you want 1 p.m., you put 13. So on and so forth. And um, here 12. And this box is basically the name of like how it's shown on the chart. Like for example, if I go there, so it says 10 a.m. If I change that to, let's say, like veto, it's gonna show veto. Other than that, I don't use anything besides this in this indicator because I don't know what theirs stands for or whatever. I never talked about it with Altmaniac. He's working on an SMT divergence indicator though, which I'm testing out right now, like actively. If it's any good, guys, I'll share you with you guys. So like for example, if you can't watch intermarket price action simultaneously, that indicator comes very handy, you know. So at the SMR zone, should we wait for liquidity to get rated before considering a market maker model? The easiest setup seemed to occur after stop rated. Also regarding SMT, which one is normally the leader? For liquidity rates, depends on the asset. So what's gonna happen is in the buy model, because the reversal happens at the lows here, the weaker pair or the weaker asset will rate the liquidity, whereas the stronger one is not going to rate it. It's going to leave it untouched. So for consideration of market maker model, like I said, you got to be watching simultaneously. Because if you're watching only Nasdaq, for example, here, you don't know what ES did there at the lows. Did it take the lows or not? You don't know that. You're welcome, brother. Also regarding SMT, which one is normally the leader? I'm not sure if I understand that question. Or did I already answer? I think I already answered that. I mean, you probably meant like which one is stronger, which one is weaker, I guess. Like if you're bullish and if you're seeing ES is not rating the lows, whereas Nasdaq is rating the lows, then your focus should be trading or buying ES over Nasdaq, and vice versa for a bear scenario. Like if you see Nasdaq rating the highs, whereas ES is not failed to do so, means ES is weaker. You should be short selling ES instead of Nasdaq, preferably. I don't do that, but technically how what I should do as well. Sometimes when a market maker buy model goes to EQ, I get conflicted with thinking it's turning into a market maker sell model. From there, it will start to go down instead of going up. So that comes down to the last class pullbacks, deep pullbacks. You got to understand that it is not going to stop until an order block fails. You got to be mindful. You gotta consider that. Like for example, it's going higher here. Why? Because the order block is there. Here, it never violated there. It's just pulled back. This is a deep pullback. It shouldn't even wick there. That's the general rule of thumb. The order blocks should secure the price to go higher. Because all this PD arrays here, like this, propulsion block. It's not an order block. Same thing, propulsion block. Same. These are not order blocks. Yep. That's why, like, understanding market maker models comes with understanding all the ICTPD arrays. If you don't know what an order block is, you should be learning what order block is first before jumping into market maker models. So yeah, guys, for exercise, before I forget that, let's take a look at the exercise. What I want you to do is basically, I want you to go on TradingView, pull up to assets that you've been trading the most. Could be anything. Doesn't have to be Nasdaq. So I want you to analyze both assets simultaneously and try to find a market maker model. Whether that's sell model or buy model does not matter. Time frame does not matter. You can go back in time. You can use Forex replay if you want to. Doesn't matter. But what I want you to do is when you find a market maker model, try to annotate its original consolidation and reversal with SMT divergence if present, if that's present, and then later establish the market maker model framework, meaning dealing range. When you establish the dealing range, now annotate. I want you to annotate all the PD arrays you can find in the expansion link until the price delivery algorithm reaches the original consolidation target. Okay. Now, one note there. What I want you to do is when it comes to annotating the PD arrays, I want you to only focus on the discount PD arrays if you find a buy model, and I want you to only focus on premium PD arrays if you spotted a sell model. Okay, I don't want you to be confused or you know uh, focusing on the other side of the spectrum. It's not necessary. Your eyes should be just looking at the discount PD arrays when it's in a buy model, and vice versa for sell models. And I want you to guys to post your charts in the exercise channel. When you're done, that's it, guys. I'll be looking at your charts, giving you some corrections if necessary. If not, we'll go from there. So yeah, thanks for coming by today, guys, for this class. I'll be uploading this in the recordings channel. Also, I was thinking about changing the schedule for the classes because I believe like a lot of people cannot tune in because they're working and stuff. I'll probably make a poll or post a poll, so I would appreciate your input on that because I really need to optimize the time around everybody in the group. Um, but yeah,